My name is Ernie Humphrey. I'm the Vice President of Educational Programs for Performative, the online community for corporate finance, accounting, treasury, and related professionals. First, I'd like to welcome everyone to the webinar, The Eurozone, Downside Risk or Growth Opportunity. Our webinar today features Eurozone market strategist Ravi Bhardwaj, Western Union Business Solutions. Ravi will outline his assessment of why the downside to risk in the Eurozone has been overemphasized and will break down the factors that will influence its economy over the coming 12 months. He will examine the wild currency gyrations that have eroded currency value and increased the cost for businesses to raise money, and will explain how these factors will affect your ability to do business with companies in the Eurozone. I would like to thank Western Union Business Solutions, whose commitment to thought leadership helps us make this event possible and delivered at no cost, like everything we do at Performative. A quick note on today's agenda. First, we'll hear a presentation from our featured speaker, Ravi Bhardwaj, and we will move into our interactive Q&A session. We will spend the remainder of our hour. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your go-to webinar control panel to send us your questions. We can't promise to get them all in, but we'll do our best, and we'll follow up afterwards on any questions we did not get to during the webinar today. A few more logistical notes about the webinar. A link to today's presentation and video of this webinar will be sent out to all attendees within 24 hours of the event and will be posted on Performative.com for free download. Those who would like CPE credits through NASBA will answer all the polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please contact Chris Brower at cbrower@performative.com. We'll have Chris's contact information again later in the presentation, so don't worry if you didn't catch that on this slide. You will be asked to take a short survey today regarding today's webinar. We greatly appreciate your feedback regarding today's event today, as we always strive to improve the ROI we offer our event attendees for your valuable time. A quick word about Performative. Performative is the largest and fastest growing online community and resource for senior level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Okay, let's get started by introducing today's featured speaker, Ravi Bhardwaj, Market Analyst, Western Union Business Solutions. Ravi is a Market Analyst for Western Union Business Solutions, and he is responsible for presenting his views on contemporary currency market developments to NA and APAC audiences. In this capacity, he prepares independent daily and weekly briefings for the firm's senior managers and clients. He has been frequently quoted in various prominent publications, including the Wall Street Journal, Bloomberg, and Reuters. Ravi joined the firm in 2008 as part of the Treasury Unit. Ravi has a BS in Industrial Engineering from Rutgers University and is working towards an MLA with concentration in finance from Harvard University. With that, it's my distinct pleasure to hand the floor over to Ravi. Ravi, take it away.
Thank you so much, Ernie, for that wonderful introduction, and a special thank you to Performative for having this webinar, and hello to everybody joining in. Our presentation today is on the Eurozone debt crisis, and it's specifically titled "Crying Wolf in the Eurozone." We've chosen this title because what we're trying to present here is a contrarian view on the Eurozone crisis. And it's one of the most acerbic crises that's been plaguing the world economy in recent times. In particularly over the last year to 2 years, there's been this mentality within at least the markets, and that's been now pervading into the business community that the end is very near. The future forecast for the euro is the Deutschmark or the French franc or something to that nature. And what we want to do in this presentation is to allay some of those fears, while recognizing that the severity of the Eurozone crisis is quite significant. With all that said, I'd like to talk about today's agenda. We're going to start with an overview of some of the recent developments in the currency markets, and also briefly touch upon the basic tools that currency analysts use for analyzing currencies. Following that, we're going to have a discussion on the meat of our topic, which is going to be on the Eurozone debt crisis, how significant it has been, why it has been this significant, and a special discussion on some of the key participants of the crisis, including a discussion on Greece and Spain. And finally, we will be wrapping up this discussion with a discussion on how to hedge when it comes to this crisis. Obviously, there are opportunities here, and all those opportunities contain quite a considerable amount of risk. And it's quite important for business leaders and captains of industry to know how to circumnavigate these new waters so that they can, ensure the profitability both for their investors as well as for their employees. So without further ado, I'd like to get started with an overview of the trajectory of the U.S. dollar over the past decade or so. Here, what I've charted is something called the trade-weighted U.S. dollar, which is the value of the U.S. dollar against a basket of currencies rather than an individual currency. And one of the main things that you can take away from this graph is that the value of the U.S. dollar has actually sort of entered a new period as of about July of 2008. From early 2002 all the way until mid-2008, the U.S. dollar experienced steady and constant depreciation against a basket of currencies. This was largely due to two ever-growing deficits within the United States, and those were the fiscal deficit, and the second was the current account deficit, or the trade deficit that the U.S. was accruing with the rest of the world. During this time, you had a demand for dollars dropping compared to an increase in demand for foreign currencies, and that's why you had a drop in the value of the U.S. dollar. Now, since the onset of the global financial crisis sometime in mid-2008, the value of the U.S. dollar and the broader trajectory of the world's top reserve currency has changed considerably. Gone are the days of steady and constant depreciation and low volatility. Volatility has been extraordinarily high for the U.S. dollar, and for any caller who, or for any participant who has any direct involvement in terms of currencies, you can understand that at certain times of the year you might have up to a 30% change in terms of your currency payment values compared to other times of the year. So how do currency analysts look at this, and how do analysts really extrapolate the information? Well, there are a couple of different ways, and one of the main ways that used to be very prominent in terms of currency analysis, especially for the U.S. dollar, was to use the paradigm of gold. Gold used to be a great hedge for U.S. inflation rates as well as for the potential depreciation in the value of the U.S. dollar. And this was due to two particular particular events in terms of the histrionics of gold. First, you had the fact that the U.S. dollar was actually based on the value of gold for an extended period of time, and following that, there was a period where gold was seen as a great hedge for the U.S. dollar, primarily due to psychological reasons. And so when you had this sort of a triangle between the U.S. dollar, global currencies, and gold, and in this particular triangle, if you ended up in a scenario where the U.S. dollar was depreciating, global currencies were stable, it presented an opportunity for investors to use this triangle and appreciate the value of gold. And obviously, the situation would work vice versa. Since about 3 to 4 years ago, this particular relationship has not been very useful. There are two particular reasons for that. First of all, the gold standard no longer exists, and more importantly, the psychological bounds that were holding the relationship together have been slowly and steadily been eroding. Second of all, we have increased central bank activity within the gold market as central banks are amassing increased exposure to gold, and this has fundamentally changed the supply and demand of gold, and that explains why a couple of years ago gold was trading at about $400 to $500 an ounce, and now is trading excess of $700 or $1,700 or even $1,800 an ounce. And this is all despite the fact that the U.S. dollar hasn't considerably depreciated, and neither have U.S. inflation rates considerably appreciated. Now, taking gold aside, another way that you can analyze currencies is to look at this economic theory known as purchasing power parity. Essentially, for anybody reading who's read The Economist, purchasing power parity is no different than the Big Mac index, and that is to say that if you have one McDonald's Big Mac, which is worth $2 in the United States and worth £1 in the UK, the relationship between the U.S. dollar to the UK pound should be 2 to 1. While easy in theory, it's very difficult to apply in practice because of the fact that goods and services in one economy may not be offered in another economy, and more importantly, how that good is treated may be very, very different. So given the fact that neither gold or purchasing power parity are very effective at explaining currency rates, the best way to really analyze currencies is to look at their fundamental interest rates and economic drivers. And to that extent, there have been a couple of major economic developments over the past couple of years. Certainly, the slowdown in China has had a tremendous impact in terms of the global economy, and certainly in terms of the value of the U.S. dollar and the broader economy, and the broader industrialized world currencies. And Chinese growth rates are certainly not growing at double-digit pace anymore, but nevertheless, China has averted a hard landing. The U.S. economy has been experiencing lackluster growth as of the global financial crisis, and the looming fiscal cliff continues to be a source of significant frustration for market participants. And this frustration has certainly been felt by businesses at the end of the day who find it difficult to make long-term decisions given the fact that there are tremendous risks that lie just within a 2 to 3 year basis. So, and then finally, one of the main things that in terms of a pure financial event that has really changed a lot of things has been this recent rally in commodities and also its sell-off, which has affected a lot of commodity-sensitive currencies such as the Australian dollar and New Zealand dollar and the Canadian dollar. Now, taking all of these things aside, the Eurozone debt crisis really stands apart. It's been one of the most significant crises that has ever impacted the world economy. So, and how significant has the crisis been? Well, it's been alluded to in almost every single rate decision made by the industrialized central banks. And so these include Australia, New Zealand, Japan, the US, Canada, the Scandinavian countries, the individual central banks within the Eurozone for sure. And the fact that it's actually being alluded to by these individual, by all these central banks is quite significant because central banks, in the end of the day, tend to be relatively selfish institutions that are primarily concerned with the economic developments within their own jurisdictions. So the fact that these central banks are actually considering exogenous influences on their economy from the Eurozone is a testament to how much central banks are willing to go outside their jurisprudence to really ensure that they have a comprehensive picture of what's going on. Another way to gauge the significance of the crisis has been the fact that it's been a key driver of volatility within the equity markets. For any major market participants with exposures to equity portfolios, or who's managing a company that has outstanding shares trading in the equity markets, I'm sure you can understand that earnings announcements are no longer the primary reason for changes in values of equities. Certainly, the changes in what's going on in the Eurozone do have a considerable impact in terms of the undulations of equity values and share prices. Exaggerated changes in sovereign interest rates are a third way in which you can detect how significant the Eurozone crisis has been. At certain times of the year, certain countries have interest rates fluctuating by a factor of 2 or even 3 because of the various changes that are happening in the Eurozone. So these are some of the macro reasons for why or how significant the crisis has been. To understand how significant the crisis has been on a more micro scale and for how it's been particularly important for corporates, it's best to probably take a step back and review a wonderful quote by Professor Michael Porter from Harvard Business School, who recently stated that a location decision is in many respects a referendum on a nation's competitiveness. And the way I interpret that is that it's quite reflexive, that a country is competitive because of a company, and a company is competitive because of a country. So whether you have a major supply chain, a major element of your supply chain that's connected directly or indirectly to the Eurozone, or whether you have a major aspect of your customer chain that is directly or indirectly connected to the Eurozone crisis can have quite a significant impact in terms of your bottom line. And sort of three fundamental risks that you should be able to relate to would be sort of the credit risk, the liquidity risk, and the supply chain longevity risk that the Eurozone crisis can impart on you. Certainly, in terms of for market or callers that who have foreign subsidiaries, you can understand that if the foreign subsidiary is seeking financial products from a local bank in the Eurozone, that particular subsidiary will have a more easy time or a more difficult time depending on the fluctuations of or the undulations of the broader Eurozone crisis. Liquidity risk pertains to more short-term investments, but even that has been quite hampered, even within the United States, because of how difficult things have been in the Eurozone and how complicated capital formation in general has been in the United States. Supply chain longevity is kind of a no-brainer. If an element of your supply chain, both in terms of customers or in terms of delivery or in terms of an actual supplier, has significant exposure to the Eurozone, the longevity of that supplier or that customer can be put into question based on how severe the Eurozone crisis gets. Now, the impact in terms of currencies has been extraordinary. Here, we've basically charted the value of the euro against the US dollar for over the last decade. And as you can tell, the euro, much like the US dollar, had experienced consistent appreciation against the US dollar for about 6 years, starting January 2002. But since then has been on the sideways, if not downward trajectory, with significant volatility. And several of the key turning points in the value of the euro are directly attributed to the story of the Eurozone crisis. So when Greece first admitted that it had about 300 billion euros in terms of unreported funds in terms of its deficit, people were extremely concerned about the longevity of the euro, and the euro plummeted. Following that, there was the first bailout handed out to Greece, Portugal, and Ireland, and there was some level of confidence that was restored within the Eurozone. But soon after, we had concerns that a domino effect would topple over Spain and Italy, and the euro slid again. And most recently, the euro has been on sort of a mend after the European Central Bank basically engaged in something called an OMT, where they are going to engage in unlimited bond purchases of countries that have had bailouts, provided those countries are meeting those bailout requirements. So, and again, for any participant in the call that has any direct exposure to currencies, it's easy to understand that at at certain times of the year you might be paying 1.5 on the euro, and at other times you might be paying 1.3 on the euro. And it's not necessarily just operations that are impacted on this, but also forecasting your 1 year out in terms of your budgets and your expenses is that much more complicated when there are 20% swings in terms of currencies. Sovereign nominal yields have not been spared either. And this particular chart illustrates the sovereign yields on 5-year securities for 4 different countries: Germany, France, Italy, and Spain. And you can see that the crisis in general has had this very caustic influence in terms of yields for Spain and Italy, where you have massive gyrations. But every time you have massive gyrations, there's a flight to safety that market participants are engaging in that causes them to sell Spanish securities, sell Italian securities, and amass French and German securities. And as such, the worse the crisis has been getting for most of Southern Europe, the better it has actually been in terms of a fiscal standing for Germany and France, which is somewhat coincidental. But nevertheless, it's certainly been very difficult for businesses, as again, the sudden changes in terms of volatility can hamper their ability to not only perform right now, but also figure out what their future budgets are going to be. So, with the how dangerous this crisis has been wrapped up, I want to talk about why this crisis has been so caustic. And there are a number of different reasons, but most of those reasons circle around this idea of decentralization. In the Eurozone, you have centralized monetary policy, but decentralized banking regulation and decentralized fiscal policy. And this basically engenders an environment where you have where savers and spenders end up forming different segments of a distribution, where you might have an entire bimodal section of a bimodal distribution in terms of how the broader GDP or broader population and consumption activities are conducted within the economy. And so you would have savers such as Germany and France on one side, and spenders such as Ireland, Portugal, and Greece on the other side. cultural fragmentation serves an exceedingly important part in exacerbating this particular bimodal distribution. And we've certainly seen that in terms of protests and in terms of frustration within the political environment because of this cultural fragmentation. And finally, we end up with this idea of a contagion theory. Now, to explain what contagion is, I actually want to talk about a schematic where we are talking about a normally functioning market. So in a normally functioning market, you start with stable financial activity for any asset price. Following that, you have some sort of an event, an earnings announcement, or an economic report, a political statement, or anything. During that time that the event has been unleashed, market participants engage in analysis and careful consideration, at least rationally, for what actually has been happening and what its fundamental impact will be in terms of price action. Once the judgment has been made, there's a period of adjustment. And once the adjustment period finishes, you end up back with stable financial activity. This is kind of paraphrasing a key economic concept known as the efficient markets hypothesis. And under a contagion system, the model develops a kink. Basically, you still start with stable financial activity and you still start with an event, but the event is no longer just about rational analysis. It's now being interpreted as a gauge of fear. And the fear is not only about the event, but it's also about the adjustment process. So when the markets engage into this kind of weird contagion feedback loop, you end up with a constant circulation of fear and frustration and anxiety, and the asset prices can gyrate quite wildly during this period. So if we look back at the sovereign yields chart, you can see this fear happening in terms of markets at the 6% level for Italian and Spanish bonds. The 6% was, for some bizarre reason, considered a key litmus test for the longevity of any particular country within the Eurozone. As Italian bonds, sometime in late last year, started approaching the key 6% hurdle rate, investors began to completely lose their grips. And they rapidly sold off Italian bonds, started amassing German bonds, and this sudden flight to safety was to its large part quite irrational, but nevertheless quite caustic in terms of the impact it had on the broader economy. And it was finally resolved by austerity measures that the Italian government took. And again, this simple thing ended up happening again this year with Spain. And again, it was resolved after the European Central Bank stepped in with their OMT. So with the why sort of settled down and the impact of the feedback loop now understood, I want to take a second to talk about the two largest players within the current paradigm of the crisis, which has been Spain and Greece. So a discussion about Spain is almost impossible in a discussion about the Eurozone. Spain is the fourth largest economy within the Eurozone, and with a GDP of about $1.5 trillion, it can have quite a significant impact in terms of the broader the stability of the Eurozone, especially in terms of the southern countries. Within Spain, you have 17 individual regions or autonomous regions, and not all of them are as bad as the most southern half of Spain. So the Andalusia, the Valencia, the Murcia, and the Catalonia regions have all requested for bailout from the federal government in Spain, and they have certainly been in the presses very recently. But there have been a couple of different regions within Spain which have not been in such dire straits, and those include regions such as the Basque, the Castile, and the Navarone regions. The other major recent event that has sparked concern about Spain has been the fact that Bankia, which is one of Spain's largest banks, has actually been completely nationalized because of irregularities in terms of how it was being managed. So Spain represents a major potential threat for what could happen to the Eurozone in the event that it fails to meet all of its debt obligations. But nevertheless, the actual paradigm that Spain faces is twofold. First of all, there's a shift in competitiveness for Spain now that its housing boom and its credit boom have imploded. And second of all, the major thing for Spain is to really understand what it means in terms of cultural harmony, because all of these autonomous regions have engendered autonomous environments that have not been very useful for cementing across the board unified resolutions to any sort of cultural issue. Greece's situation with Spain's discussion left behind is quite different. Greece has been suffering quite significantly from the recent malaise that has been crippling the Eurozone. Its housing bubble has also imploded. It has also suffered an exacting blow from a credit crisis. And one of the main problems with Greece is that financial market participants, at least, are questioning the efficacy of its austerity measures. And by that I mean, as the public sector is cutting down its spending, the public sector was already engaging in crowding out the private sector's ability to for capital formation. So as the public sector has been cutting down on its spending and is trimming down on its impact on the broader public, it has been very difficult for the private sector to step in, given the current regulations and the regulatory environment that Greece is still holding on to offset the losses from the public sector. So the private sector is losing, the public sector is losing, and at the end of the day, the economy continues to dwindle. And this has certainly been exacerbated by a lot of sort of cultural developments that have been happening, including major protests within Greece, especially at the thought of increased austerity, which they agreed to yesterday. Certainly all of this culminates with greater and greater economic stagnation. Now, one of the things that's kind of linking both Spain's woes as well as Greece's woes, and sort of exacerbating this behind the scenes, has been these bipolar statements that have been coming from the public officials from basically a spectrum of market participants. So at certain times, certain members of the Eurozone policy chieftains would say something to the extent of the Eurozone is irreversible, and just a couple of months later it would be followed by a concern about a Grexit, which is a Greek exit from the Eurozone. There are members within their own organization that can end up constantly at loggerheads with each other. The ECB board decided to engage in OMT to sort of like stave off a default of Spain, but just a month later, or actually even days later, Jens Weidmann, who is a board member on the ECB, stated that central banks can't actually fill in fiscal gaps. And these sort of Dr. Jekyll, Mr. Hyde's statements that have been coming out of the Eurozone have been very difficult for financial markets, and particularly invective for the financial community, because it's been difficult to ascertain what exactly the end goal is for policymakers. And as such, every time you have major political statements that are at odds with what other political statements end up being, it induces increased volatility into the markets. Now, with all that said, and with the negative into account, I think it's still important for all callers and all market participants to sort of look beyond the cacophony of what the Eurozone crisis has been going on. In the end of the day, you always have an event, some sort of extreme financial reaction, inevitable tossing of the political football from policymakers, and ultimately some sort of fiscal resolution, whether that means increased cutting of spending, or whether it means increased tax measurements, or a combination of both, or toning down rhetoric, or whatever the case is. There is always some sort of fiscal resolution that ends up happening at the end of the day. And why is this particular chain of events happening? Well, in terms of tossing of the political football, that seems very easy to understand. But in terms of why they always come up with some sort of resolution, that's primarily due to the fact that there are minimal actual legal options for Eurozone members to exit the Eurozone. The Eurozone, in terms of the Maastricht Treaty, was not actually made with any provisions for leaving the broader 17-member union, and how when and all of those types of questions about an exit are very complicated, especially when untangling one economy from a unified currency. There are also strong economic relationships that have bound all the different countries with each other. So there's significant exposure from Germany to Greece, Greece to Spain, Spain to Ireland, Ireland to Portugal, and et cetera, et cetera. Now, with all that said, one in particular institution has played a particularly significant role in terms of the European Union's current credit crisis, and that is the European Central Bank. The ECB has basically, since the crisis started, has lowered interest rates, has eased collateral requirements, has engaged in a lot of long-term lending, engaged in a lot of liquidity swaps to ensure a significant liquidity within the Eurozone, and obviously been a key participant of the bailouts that have been handed out so far. And what all this means at the end of the day is that it has single-handedly increased the interdependence of Eurozone members by trillions and trillions and trillions of euros, which is that much more dollars. And so taking into account the fact that in the end of the day, all these countries have significant economic relationships between each other, and the ECB is only serving to strengthen those economic relationships, it should be understood that while the crisis continues to roil within the financial sphere and certainly within the business community, the long-term prospects for how the Eurozone could eventually come up with the necessary vision for itself to survive this crisis remain somewhat intact. So what does this mean in terms of a conclusion? And I think there are 5 key takeaways from this analysis. First, all businesses should do their part in terms of reviewing their supply chain. It's important to increase the nimbleness of your supply chain in the event of a massive credit event when there's a link in your chain that's broken. Alternatively, it's also important to recognize that it's useful to have a flexible supply chain in the event of sudden contraction or sudden disruptions in terms of global trade. And in terms of a more immediate measure, and this is something most businesses have already done since the onset of the current financial crisis, business managers should ensure that they have a high current ratio. That means maximize their current assets and minimize their current liabilities. It's always very useful to budget conservative estimations for your currency rates as well as your debt rates, so that way, if you were going to, for example, this year, for those businesses that assumed that you were going to pay 1.25 on the euro and they were importers, certainly they're not going to be happy about the fact that on average the euro has been a little bit higher than that for this year. And obviously it's going to be different for those who budgeted 1.5 for the euro. Now, in light of the fact that we are in a new Dodd-Frank environment, it's still important to recognize that if you have access to forwards can be a great friend of yours to hedge your future cash flows. And finally, in terms of a long-term strategy, it's very useful for all business owners to ensure that they have an event-based action plan. And this is not only pertains to a quantitative strategy in terms of what happens if the euro goes to 1.7 or what happens if the euro goes to parity with the U.S. dollar, but it also means in terms of what happens if the political situation in the Eurozone exacerbates to X level or Y level or Z level, or appreciates to X level, Y level, or Z level. And with that, I'd like to hand the call back to Ernie, and thank you all for listening in.
So, thank you very much, Ravi, for that great content. What we're going to do now is we're going to launch our series of polling questions. We'll keep those polling questions up for about 1.5 minutes each. In order to have the best use of our opportunity with our expert Ravi here, we're going to go ahead and start the Q&A as the polling questions are up. So we'd love to have everyone in the audience answer the polling questions. For those of you in the audience after CPE credit today, you'll need to answer all of our polling questions. Again, if you have any questions, please feel free to ask those questions in the questions area in your GoToWebinar control panel. And then with that, I will take our first question for Ravi here. So someone's just kind of asking, can you put a point on the presentation for us one more time? So the title of your presentation was in fact crying wolf. So what are the specific areas where you think folks are crying wolf, in these markets?
I think there are two particular regions where people are over-concerned and engaging in this sort of odd feedback loop. First is with actual policy, or first is with like non-policy statements that are coming out of major Eurozone leaders, which are causing a lot of consternation within the markets. And second is the actual sort of high-frequency data that's coming out of the Eurozone and sort of panicking that this high-frequency data is directly correlated to broader trends in GDP or broader trends in inflation. And to that extent, policy measures have been enacted to provide counter-cyclical help to the broader economy. And nevertheless, financial market participants seem to be hyper-reacting to these, PMI reports, et cetera.
Okay, great. I was expecting this one almost. So now that the presidential election is over, have we seen or do you expect any reaction in the global currency markets giving the results of our election?
Well, I have to sincerely apologize for not having the latest information in terms of today. We did have a broad sell-off in terms of risky assets, equities falling, the U.S. dollar appreciating yesterday due to the election results. The primary hurdle coming up is going to be around the fiscal cliff. And it's not necessarily about when it gets resolved, but it's a lot more about how. A cohesive response to this crisis that really allows for a will certainly go a long way in sort of ameliorating the financial community's frustration with the U.S. fiscal balance right now. Alternatively, if you end up with a completely partisan approval of whatever resolution they come up with, you could definitely see market participants taking that as a cue for continuing to engage in speculation that the U.S. economy is not as good as it is, or the policymakers are not on as solid ground as they should be.
Okay, great. Thank you. Can you give us, your thoughts on the recent events in Greece? You mentioned an event that took place yesterday. Is it your opinion that they're going to find a way to work those things out, and that Greece will in fact stay in the Eurozone? And then the second part of that, if there was some case where Greece were to somehow exit the Eurozone, do you think that would cause an unraveling at all in the Eurozone? I know that's been a concern of others, but do you think that's possible? Let's say for the sake of argument, Greece found a way to exit. Do you think that Spain would follow?
I'm not sure I quite understood the first part of the question. Was it pertaining to Greece staying in the Eurozone?
Yes, yeah. So so given the recent political unrest and the strikes in Greece, do you think there's going to be an adequate response to calm that down and keep them in the Eurozone? That's part one. And part two, let's say for the sake of argument, that there is a path to exit the Eurozone and Greece exits the Eurozone somehow. Do you think that would unravel? Cause Spain to follow or any other countries in the zone to follow?
Well, in terms of part A, the big problem is pertaining to the crowding out effect that's going on in Greece right now. The fact that the government has, in fact, reached a point where it needs to cut back and can't foster an environment for the private sector to really take over has been very disruptive for the Greek economy. It's not certain when exactly it's going to end. One of the most frustrating aspects about all of this is that every model that some of the major firms have been able to make, including the International Monetary Fund, has always been coming up with way too rosy estimations of how Greece's economy should be. They always expect that Greece's GDP should be rising back to a level that was on par with its 2005 trends, and this has never actually been the case so far. Proper policy measures that will allow the private sector to grow at a faster pace than the government cutting back will be a key element to seeing Greece sort of getting restored into a proper economic growth trajectory. And when it comes to the second part about actually how Greece is leaving, given the fact that there is no actual legal structure to do it, it's very difficult to estimate what the impact that would have on the financial community. You would inevitably need someone to engineer an exit policy. And how that policy gets engineered will have an impact in terms of the financial markets or in terms of the euro or all the other risky currencies. It'd be impossible to guess that right now.
Okay. Someone's kind of asking a follow-up question earlier. So it seems like part of the crying wolf is that this fear that the Eurozone is going to fall apart and the euro as we know it is going to change. Can you just highlight the 2 or 3 things that you think that people are missing one more time to those folks who have that alternative opinion? What do you think that they're missing that won't happen to allow that to take place?
Well, I think first of all the strong economic relationships between all the different economies, the extraordinary efforts taken by the European Central Bank to ensure that proper not only liquidity provisions but actually debt provisions to some extent, and finally the general willingness of politicians, even in this environment, to accept that the Eurozone is a bigger cause than their individual economies are all sort of reasons for why overwhelming frustration or overwhelming expectations that the euro is going to end might not actually hold water.
Okay, thanks. You mentioned in your presentation that companies might do wise to create some strategies around what you call the event-based actions. Are there looming events, let's say top 2 or 3 events that you see on the horizon that would move currencies in such a way that corporations might want to keep a special eye on those possible events in order to prepare for them in the next 3 to 6 months?
I think the binary reactions from the fiscal cliff are certainly something to keep in mind. Again, it's always possible that U.S. policymakers can just swap out the actual date that a fiscal cliff needs to be resolved and put up a short-term budget until May of next year or December of next year or whatever the case is. So establishing some sort of plan based on the fiscal cliff would certainly be useful. In terms of the Eurozone, establishing a plan primarily revolves around more quantitative natures in terms of saying what happens if Italian yields go to X and my company's sovereign bond spreads is Y. So what happens if if I have to pay X plus Y for getting any particular loans from the euro area? What does that mean in terms of my supply chain? What does that mean in terms of my foreign subsidiary, and et cetera? And the other major thing in terms of the Eurozone is the overall is this sort of non-quantitative resolve that the Eurozone members are having with each other to state that the Eurozone is a cause that's bigger than their individual countries. If you see that particular theme changing, it certainly would mean a lot in terms of suggesting that the euro might not have the wherewithal to withstand the long run.
Okay, great. In terms of currency volatility, as you look into 2013 among currencies, major or minor, do you believe that can you name maybe 2 or 3 other currencies that you feel given might have more volatility than the euro? It seems like we're talking about crying wolf here. Are there other currency pairs which you feel corporations might want to pay more attention to?
I think the renminbi would be certainly one currency that corporations should pay attention to, given the fact that China is slowly but very surely opening up its economy and allowing more and more payments to flow through its primary currency. I think the Australian dollar next year might be shining more than the euro. And this is because of the fact that the resource boom that has really sustained the Aussie so far, and the Australian economy actually so far, is ebbing. And even the RBA has actually acknowledged that it expects the resource boom to actually peak sooner and lower than expected.
Okay, great. Someone's asking you to share your vision of what the Eurozone will look like over the next 5 to 10 years, and if there might be any warning signs that you might be watching for that might change your view of what the Eurozone might look like over that time frame.
Over a 5 to 10 year time frame, I would say that it would be weak but not out. But I would say that the primary sort of litmus test to see a change in that forecast would be a change in the resolve of the individual countries. Again, that has been one of the most constant and welcoming aspects of the Eurozone crisis so far. The fact that, when really pushed to its limits, that policymakers have been able to band together and actually been able to come up with the necessary resolutions to placate the markets.
Okay, great. Kind of circling back again, hit this question again. Given our political event here in our country, are there any upcoming political events in the next 3 to 6 months that you think people should watch for that are be occurring in the Eurozone?
Greece's request for greater flexibility in terms of how it's implementing austerity over a 5 to 6 year frame. That's actually on the table right now, and it's hotly debated between the key policymakers that have been behind the first bailout. That's a major political event to watch for. Obviously, the American fiscal cliff is something that we need to be watching out for. One of the recent trends that we've been seeing has been some weakness that in Germany, and actual structural weakness in Germany that doesn't seem very cyclical. So how that permeates into the broader Eurozone economy and whether that translates into some sort of like new industry formation or a new capital formation or whatever the case that might be, we might how that gets reacted from a policy response might be something we might want to look for. But I would say that the Germany's economic malaise, as nascent as it is not as pressing an issue as the fiscal cliff or the Greek austerity question.
Okay, great, thank you. Someone's asking a question around, we mentioned one of the key areas is Spain. So if someone is wanting to become more educated and follow Spain and the fundamentals and drivers of what's driving the economy in Spain, do you have any suggestions of how people would understand the risks there and what could really drive the economic conditions there?
I think the autonomous regions within Spain complicate any easy analysis of the country. The individual regions of Spain have a lot of leeway in terms of how they structure their budgets and how they manage themselves. And they actually dislike seeking federal assistance because of the fact that it ties them in terms of how they manage their own budgets. And sort of understanding the cultures that belie that can be quite complex. I'd be happy to entertain that question if the writer emailed me.
Okay, great, thank you. We mentioned obviously Spain and Greece. Are there any other countries in the Eurozone that you feel are kind of on the verge, or there might be some noise where there might not need to be some noise on their economic conditions?
I think every country in the Eurozone is actually always considered on the verge, according to this crisis. Spain, Greece, Portugal, Ireland, Italy, and all of these countries have certainly suffered from the crisis in terms of bad reputations in the press. But extenuating circumstances can certainly help them out. But nevertheless, continued exacerbation will hurt everybody within the Eurozone, and like I said earlier, there seems to be nascent signs that there are structural problems that are developing within the German economy too.
Okay, great, thank you. I'll give the audience an opportunity to, again, ask questions. Ravi's been a great sport in giving us a very long Q&A session, so I'll give the audience one more opportunity. I will go ahead and ask one more question here that we have teed up here. So as far as what we are, again, put a point on this, what we're going to see, over the next 6 months in Greece and Spain. Just what are those 2 or 3 key things that people need to look for? I guess that's one question. I guess I'll add another question in here. You noted this fear and feedback loop. Do you think that will ever change or evolve in any way?
So in terms of some of the key points to look forward to, Greece's upcoming, any sort of resolution on Greece's request for some flexibility in terms of how it implements its austerity measures is going to be something to watch for. The ever crying or the ever loud battle cry between politicians for whatever the case may be in terms of trying to elect a new government or anything like that, that can always cause a lot of frustration within market participants. And if that were to happen, that might be a source of caution for businesses. And finally, the actual implementation of the European Central Bank's latest OMT, which is the outright monetary transactions program that the ECB made to help out countries that have already received the bailout, how the ECB actually implements that program and tests it out, and whether or not that's actually very efficient at reducing sovereign bond yields, that's also going to be something to look forward to from a policy response.
With that, given Ravi's patience with our Q&A session, I'll go ahead and close the Q&A session. I'd like to thank Ravi for his time and insight. If you'd like to connect us directly with Ravi, please indicate that on the survey we invite you to take immediately at the conclusion of the webinar. Ravi is clearly a leader in his field and an excellent source of information on today's topics. Our thanks again to today's sponsor, Western Union Business Solutions, whose commitment to thought leadership allows us to offer great programs like the webinar today at no cost. Again, if you have any questions regarding CPE credits, please send an email to cbrower@performative.com. And finally, I would like to thank the audience for your valuable time today. We hope we've offered you some valuable information here today. And with that, I'd like to close the webinar, and I look forward to seeing you all on performative.com at future performative events. Thank you very much. Take care.